market and wonder what is actually going on? What really makes those prices jump up and down? Well, you might be surprised to learn it's not nearly as complicated as it sounds. Over the next few minutes, we are going to cut right through all that Wall Street jargon and get to the core of how it all works. So let's start with the biggest question of all. Who is pulling the strings? Who actually decides what a stock is worth? Is it the company, some government agency, a panel of experts in a smoky back room? Well, the answer might surprise you. But to get there, we have to start with the basics. What even is a stock? Right, so section 1, what is a stock? It all starts with a single slice of the pie. Before we can even begin to talk about the market itself, we've got to understand the one thing that's being bought and sold. And let me tell you, it's so much more than just a ticker symbol on your phone. Okay, this is my favorite way to think about it. Imagine a company is a giant pizza. Seriously, buying one share of stock, that's like buying one slice of that pizza. It's that simple, but it's also a really powerful idea. So here's the official definition. A stock or a share is just a small piece of ownership. And that means you become a shareholder, which is really just a fancy way of saying you're a part owner. So if you own, say, one share of Apple, you technically own a tiny, tiny piece of every single iPhone, every App Store transaction, every cool new headquarters building. You are, quite literally, a part owner of the business. But why would a company want to sell off pieces of itself? Well, it's all about raising money. Think about it. They need cash to grow, to build new factories, hire brilliant engineers, or invent that next game-changing product. The stock market is basically this incredible matchmaking service that connects companies with big ideas to people like us who have money to invest. Okay, section 2, the two stock markets. This is where the buying and selling actually happens. Now that we know what a stock is, let's talk about where all this trading goes down. And this is where we hit a really important detail that honestly most people just completely miss. Believe it or not, there isn't just one stock market. There are two. First, you have the primary market. This is the big debut, the grand opening. It's called an initial public offering, or IPO. This is the only time the money you spend goes directly to the company. Then, everything else, all the trading you see on the news every single day, that's the secondary market. That's just investors like you and me, trading those already existing shares back and forth. Let's really let that sink in because it's so important. When you open your brokerage app and buy a share of, say, Tesla, your money does not go to Elon Musk. Nope. It goes to whatever investor on the other side of the world decided to sell you their share. Tesla got its big payday way, way back during its IPO. What we're all doing now is trading in the secondary market. All right, section 3, the engine of price. This is the invisible force that moves the numbers. And this is where we can finally answer that big question from the beginning. If the company isn't getting the money from these daily trades, then who in the world is setting the price? And the answer is nobody and everybody. There's no person in a room, no supercomputer, no government committee setting the price. It's all determined by one simple, elegant concept: supply and demand. Just think of it like a seesaw, constantly trying to find its balance. Here's how it works. Let's say a company announces some incredible new technology. Everyone gets excited. Suddenly, way more people want to buy shares than there are people willing to sell them. Demand is high, supply is low. So what happens? Buyers have to offer more and more money to convince a current owner to part with their slice of the pizza. And just like that, the price goes up. Now, let's flip the script. Imagine that same company reports terrible news. A disaster. Now, everyone who owns shares gets scared and wants to sell. Supply is suddenly huge, but nobody wants to buy. So what do the sellers have to do? They have to lower their price and lower it again until they finally find a buyer who's willing to take a chance. And the price goes down. So when you really boil it all down, what's driving this whole seesaw of supply and demand? It's us. It's human sentiment. It's pure emotion. It's the optimism and, yeah, the greed that a company is going to change the world, and the fear and panic that it's all about to fall apart. You can almost think of the stock market as a giant real-time poll of our collective feelings about the future. Okay, section 4, tracking the market's health, or how we measure the entire forest, not just one tree. So that's one stock. But there are thousands of them, all with their own little seesaws going up and down. So when you hear on the news that the market is up today, what does that even mean? Well, we use something called a stock market index. It's basically a shortcut. Instead of trying to track every single stock, an index just grabs a big representative group of them and tracks their combined performance. It's like taking a poll. You don't ask every single person in the country, you just ask a sample to get a good idea of what everyone's thinking. An index is a sample of the market's health. And the most famous one you'll hear about is the S&P 500. It's basically a big shopping basket that holds the 500 largest, most important companies in the US. You know, all the big names. So, if the S&P 500 goes up, it means that on average, those 500 giants are doing well. And that's a pretty darn good sign for the whole economy. All right, final section, how investors make money. We're connecting the whole system right back to your wallet. We've talked about what stocks are, where they're traded, and what makes the price move. But let's get to the real bottom line. How do you actually make money from all this? Well, there are really two main paths to profit in the stock market. The first one is the one everybody knows, capital gains. You buy a stock for, say, 20 bucks, the price goes up, and you sell it later for 40. Boom, profit. But there's a second way, and it's super important. It's when the company you own a piece of actually shares its profits directly with you. They're called dividends, and I love this way of thinking about it. You can think of getting a dividend like getting a thank you note with money inside. It's the company literally saying, hey, thanks for being an owner. Here's your cut of the profits. And you should absolutely not underestimate these little thank you notes. They are a huge deal. Get this, since 1926, over 30%, a third, of the total return from the S&P 500 has come directly from dividends being paid out and reinvested. And this chart just lays it all out for you. When we talk about how much money the market makes over the long haul, we're talking about total return. And that's not just the price going up, it's that powerful 1-2 punch of price growth plus all those dividends getting paid out year after year. So, when you strip away all the jargon and the scary looking charts, that's what the stock market is. It's this incredible engine that connects people who have great ideas with people who have the money to fund them. And in return, it gives all of us a chance to share in their success. So here's a final thought to leave you with. We know the market is driven by human sentiment. So the question is, what sentiment do you see driving it today? The next time you see those numbers flashing red or green on the news, remember what's really behind them. Millions of people, just like